Welcome to another episode of the Will Frederick Podcast, where we talk about real estate, wealth building, money, and life. We have a very special guest. Jeremy Frederick has joined us today. Today, we're going to talk about a really cool topic that comes up a lot at our family stuff and is really important, I think. So we have two different approaches to investing. Jeremy, like all of my siblings and my parents, we're all investors. He's more of a Dave Ramsey, pay cash for everything, play it safe. And if you've talked to me for more than about 5 minutes, you know I'm more like Robert Kiyosaki, leverage everything, scale up quickly. It's a different approach. Wouldn't you say, Jeremy?
Your home is often your largest investment. Trust the professionals at Fleur de Lis Law and Title for reliable, secure closings. With 10 offices across South Louisiana, Fleur de Lis is your trusted partner to ensure the title to your home and the money you invest are secure. The experienced attorneys and staff at Fleur de Lis can also take care of your real estate planning and succession needs as well. Fleur de Lis Law and Title, Louisiana's leader in reliable, secure closings. And let me tell you, we do the vast majority of our closings with Fleur de Lis. We have had great service. The attorneys there are just fantastic. So we love doing business with them. We highly recommend them.
Yeah, I definitely agree. And I would first start off by saying, if you have any question which one's better, who has more hair, that will go ahead and tell you.
Yeah, you're cheating though. You got long hair. No, look at that. Oh man, like Jeremy. We always joke Jeremy's got like movie star hair. I'm like, what did I do wrong?
In borrowing.
Yeah, maybe yeah. So I guess that answers the question I was going to ask: who sleeps better at night? Who's a little bit less stressed? Who looks less stressed? So
right.
So how would you describe your investment philosophy, Jeremy? What would you call it?
So my investment philosophy is just easy. Do what you do good, and then do everything else as easy as possible. So as opposed to trying to run around, and I do have rental property, but instead of venturing out to rental property, I would much rather put my money into stock market, let it grow, and then me just use my work as my primary source of income. So that's pretty much it. Just ease, make it, set it and forget it, never have to deal with it again. Don't try to learn something new. Just do what you've been doing.
So it's interesting because you and I were raised by the same parents, right? Now, all five of us. And, as most families, like each kid is way different. And it's funny because, people have met us before and said, oh my gosh, you're related to them because we're so different, but we're really good friends. And I'm very grateful and blessed to have a brother like him who has put up with me for a long time. So who would you say has influenced your approach to money? I mean, obviously our parents did, but I mean, that could be one. Who would you say?
Yeah. I mean, obviously I think all of us get it from each other, right? So like just being around y'all, it harvests, it like breeds a level of knowledge or whatever for investing. So we always sharing ideas and, oh man, that's a cool idea. Let's try that. And like we've done investments where we'll flip a property.
Yeah, we flipped the property together. A couple of them.
You borrowed for your half, and I paid cash for mine.
It went that way exactly.
Yeah, yeah. But I mean, it's a bunch of good people being around. I've learned a lot. I work at a chemical plant, and there's a lot of guys who started young and invested 401k their whole life, and they retired multimillionaires. So I learned a lot from them. As far as like celebrities, I guess, like Dave Ramsey, obviously. I mean, I do agree with some stuff Kiyosaki says. It's just not the way I chose to go. Morgan Housel, obviously.
Oh, yeah, Morgan Housel.
Collins.
Yeah.
Those are probably my main four.
Yeah, those are good influences, and I've studied those heavily too. So it's interesting. Jeremy mentioned something like, again, there's five of us. I'm the first, and he's the second, and then we have two more sisters and a younger brother. And all of us, like we get together at family stuff, and it's like this big real estate mastermind. We're all talking deals and like, hey, what's going on? And it's so fun,
And all completely different. You got.
Yeah.
He's the boss. I'm the laid-back brother. Then we have a boss sister. And then there's a laid-back sister. And then there's Jeff. He's just whatever.
Many of y'all know my brother Jeff. He's a realtor. He was on my team for years. So another good guy. And we're all really good friends. We've all been in each other's weddings. Jeremy's got a wedding coming up here. So by the time of this podcast, he's probably going to be married. So
Yeah, just in time to get that overtime tax deduction.
Yeah, there you go. See, Jeremy's a big student of taxes too. We'll talk a lot about tax returns and how to save money on that. So it's a lot of fun. So when did you first start taking money seriously? Like, what triggered that?
So I think I've always been a saver, but once I started working at where I work now, so probably about 12 years ago, I realized I'm like 34 years old. I don't have I had like $1,500 saved up from a 401k that some company just put in there for me. And I was like, oh man, one day I'm gonna have to retire, so I better start saving. And then luckily I was in a position where I was making decent money, and it grew to be much more decent money, and I was surrounded by people who were just steady investors. And so that's where I kind of started saying I really need to start saving. And probably for the first, there was probably two like hurdles. So the first one was that, just starting, and then when I got to probably $250,000 in my 401k, I just start like rolling. And I was like, man, this is pretty serious. This could really work. And so that like encouraged me to learn more and invest more and just get that snowball going faster and faster. So,
yeah, I remember like hearing you talk about investing stuff. And I'm like, man, Jeremy's like, he's learning some smart stuff, you know, like, I'm like, this is awesome, you know, and been really proud of you, by the way. I have to say that like publicly, like how proud I am of all my siblings, but Jeremy, like you're doing awesome. And I appreciate that, even though we're way different the way we approach it, but I really have a lot of respect for it. Yeah. So I think it's awesome. So, all right. So if you had $100,000 right now, what would you do with it?
Well, so part of this is, it's going to sound really stupid, but I would probably repay my emergency fund, pay it back, because basically I just had a huge emergency. I got hit by an 18-wheeler on the side of the road, so I had to buy a new car to get all that set up. So
his car got hit, and he was very close. He wasn't hit personally, thank God, you know. So
I had to use that money. First of all, money for a wedding. Obviously, you got some money coming out there. So that was, we were trying not to hit the emergency fund for that. And then when my car got hit, I was like, all right, we got to dig into the emergency fund a little bit. We were going to buy a little bit nicer of a car, so we did. And luckily able to do that cash. And so now I would just use some of that to pay that back, and then the rest of it probably just put in a 401k. Not 401k, like after-tax investment with just a diversified index fund or whatever.
Yeah, like total stock exchange, VTSAX.
VTSAX.
Jeremy is always talking about VTSAX, bro. VTSAX. Yeah. That's a Vanguard Total Stock Index Fund. So it's like a small piece of all the different stocks.
Right.
And it's a pretty safe. I mean, it's got a very proven track record. I don't even know what's the annual.
I mean, you hear anywhere from 10 to 12%.
That's pretty good.
50 years. Yeah. Like, I mean, even if I get 7, 8, I'm good, but I'd prefer 15, 20.
Yeah,
so
yeah. Why not?
I like the 10 to 12 is good.
What would I do with $100,000? How well do you know me?
Oh gosh, you'd probably use it to make a down payment on a bunch of property, figure out a way to subdivide it, and then owner finance it to somebody and let them pay the note, and then refinance it.
It sounds about right, and pull more money out of it, use that for a down payment for something else.
Right.
That or buy Bitcoin. I might buy Bitcoin with it.
You know what? This is the past 6 months. Bitcoin.
That's been a positive thing. So. All right, so let's walk through buying the same $300,000 rental property. You tell me how you do it, and I'll tell you how I would do it.
So I would just save until I had enough money and then buy the $300,000 rental property. The only thing is, so for me, I don't necessarily...
You buy it cash.
Cash.
Right, that's cash. What I thought.
Of course.
Yeah, of course.
Now, I mean, if the numbers were so, like, twisted that you're going to make yeah, I would consider borrowing, but I mean,
Man, you like wavered as you said that word. Like
yeah.
it like tasted bitter come out of your mouth. Like a borrowed.
But yeah, I would. It depends on the ROI. I mean, I like to be at 20-25%. And if I am, like, on paper before you figure out all the stuff that's going to happen, because it's never 20 or 25%. But I like to be around there. So if I could get my numbers up to like maybe 20, 30, and then, calculate out the mortgage, it would make sense. But again, like, I don't like borrowing. I just
Well, and so my approach would be way different. I would find the loan that I could put the least amount down on, and I would try to owner finance it from that seller with even less than what a bank would take down, and then I would, like you said, try to improve the property and refinance and get that money back out as soon as I could, so I'm all in debt, So yeah, it's a totally different approach, but I think both work, Well,
and one thing I would say is that I'm not going to save that money out of my pocket. I would save that. The only way I'm buying more rental property is if the rental property supplies that money. So I have an account that just has my 4 rental properties, 5 one day whenever I finish this other one. That was another story. But and then Leighton, her house, we're going to rent that one out. So
that's his wife to be.
Yeah. So we'll have 5 rental properties in one day, hopefully 6. And then when those make enough money to buy another rental property, we will. But right now, it just sits in an account. It grows. When I have expenses out of that, I pay it out of that cash account. And then when it makes money, which is usually the plan, then that just sits in the account and just waits there. And then we'll invest it when I get another one.
So you have all of your rental properties, the income, because you don't have debt associated with any of them, right?
Layton's has a mortgage because she lived there before. So
you gonna make her pay that off before y'all get married? I'm just kidding.
No, because her rate is really good. Her rate is better than mine, so I'd pay mine off before I pay
Okay, gotcha.
That one.
Smart. Yeah, there you go. I'm thinking about that. No, I'm just kidding. So like you have all of the cash flow that comes from your mostly paid off rental properties goes into one account, and you don't touch that. You don't live off of it.
Right.
You pay expenses with it for the rental property, but that's just your snowball account. So when it gets big enough, you buy another property.
Yes.
Yeah, that's awesome. So I live off a lot of my cash flow. So like, there's never any, any like accumulation really.
Yeah.
But like I said, so what do you?
We're sitting in the accumulation.
Well, I guess so. It's there. I just can't spend it.
Right.
So
and I will say, like, for me, that's definitely important because that's not my emergency fund. My emergency fund is for me, not for my properties. So like, I did have issues where like one of my houses had a plumbing issue, and I had to chase it down, and it cost me like $22,000 to run a new sewer line.
I remember when that happened.
So like, luckily I had $50,000 in that account or whatever it was. I don't remember, but that pretty much was a huge hit. And then like a week later, I get a call. The roof's leaking on another fourplex that I have, and I own half of it. So I put a new roof on that. So that was another 11,000. So like, you're talking about $33,000 in course of 2 weeks. In the middle of redoing another property that I had bought and just started a total remodel. So like, I had spent probably $150,000 cash in like 6 months. Yeah. And so needless to say, that's why I only have 4 rental properties right now, and one is in waiting. Yeah. Trying to build that account back up.
So I think you're getting the picture, my listeners here, you think you're getting the picture of the difference between the two. So this next question will be probably an interesting take on that. But what do you consider risky? What's risky to you? Because I'll tell you how I think about risk, but I want to hear what you think.
I know how you think about risk. For me, risk is just anything that puts you outside of where you can handle a problem, like any unforeseeable problem, and not have to worry about it. Like, for me, risk isn't about, like, I don't care. I could lose everything I have tomorrow and go move to a beach and like sleep in a tent. Like, I'm fine with that. But for me, risk is like what would make people worried. So like if you ran into a problem where you had like when I had that plumbing issue, that was like made me feel like, oh my gosh, like this is terrible. That's risk.
It's stressful.
Yeah, stressful. So that's risky. But like if I would have had a mortgage on top of that, that was like that would just sink me. Like I wouldn't be able to cover that. And so that would actually be the risk, is like you're already running close to the edge, and any little hiccup could put you over. I like living with a huge buffer between me and the edge, and then I can live as carefree as I want and go into that buffer, and I'm all right because I know I'm nowhere close to the edge.
Yeah, so that's interesting because I think I understood something about your philosophy. And I've understood it before, but it was just really clear to me when you were talking, because if you don't have a mortgage and nobody's paying rent, that's not killing you. You're not having to like stress about that, because all you're doing is not making money, and you already said you don't spend that money anyway. So it really makes zero difference in your lifestyle. In essence,
right.
I mean, you want to have that income. It's better to have it than not have it. It's better to have that account growing than not growing.
Right.
But it's not like going to change your life. You're not like up late at night or whatever. The opposite, the way I am, like, so to answer the question about risk, to me, risk is like not getting the deal, like FOMO, you know, like passing up on a good deal. That's risky to me. I'm like, I don't want to miss out on that good deal, and that could get you in trouble. I try to be a little bit on this side of that, but you know, when one of mine is vacant, it's not only not making money, it's like costing me money because I've got a note to pay. I mean, I think every single one of my properties, with the exception of one, I have paid. I need to go borrow on that one while I'm thinking about it. Anyway, so but that's how risk is to me. I'm like, I don't want to not. But the interesting thing, because like, again, we were raised by the same parents, and it's funny to me because, you know, mom and dad don't worry about a whole lot. Like, they're just pretty carefree, you know, but their stuff is mostly paid off too. Like, they're very much like you and dad are a lot alike in that way, I would say. And but I think for me, and I've talked to Rhonda about this before, my risk muscle is like broken a little bit. Like I don't stress. I really don't stress. What would stress most people, I remember when dad first found out, like at that time I was only $1 million in debt. You know, I'm past that now, but dad found out, he was like, you owe $1 million. Are you okay? Like, are you like, he got worried for me, and I'm like, yeah, I mean, like it's fine. You know, I'm paying my notes and everything's fine. And so anyway, I think sometimes there's something wrong with me, like my wrist muscle is broken. But yeah, so I don't really think about risk the same way. But I understand that it's a lot more stressful. There's a lot more on the line if you've got that like not leveraged. If you're not leveraged, you don't have a note to pay. If you are leveraged, like you go from like way above to like way below. You know,
right.
It's like trading on margin, to use a stock term.
Yeah,
you know?
yeah. And like for you, like I look at it like I live with a huge buffer between me and the edge. So if I'm not going to fall off the edge, you're playing with house's money. So at that point, if you fall off the ledge, who cares? Like, you didn't have it in the first place. Yeah. So it doesn't matter.
And that's kind of how I think about it. Like, I don't really worry. I've never lost the house's money either. I'm not a person who's like, I'm not going to pay my bills. Yeah. But it is like, I am kind of like, oh, well, it's not really that big of a deal, you know?
Right.
So who sleeps better at night?
I mean, I sleep pretty good, but I do wake up at like 3:30 in the morning to go to work. So
yeah, I guess I sleep later than that. I haven't seen 3:30 on the waking up side in a long time. I haven't even stayed up that late in a long time. But Rhonda would say I sleep pretty well. So I don't know. It's just like I said, maybe my wrist muscles.
I mean, look.
Yeah, well, right, again, we go back to the hair. Yeah.
I sleep pretty good.
I don't know. Would I trade all my debt for that head of hair? It's tempting. That is a pretty beautiful head of hair. So what's one thing you admire, maybe begrudgingly, about the other person's strategy? So like me about you, you about me. Is there anything?
No, yeah, 100%. I mean, your way is a lot faster. I mean, and you don't need a lot of money to do it. Mm-hmm. Like for me, my personal way that I invest is, it makes me happy, but it's because I have a higher salary than most people. So I'm very fortunate to have that. And
you work hard for it. I'll interject there. Jeremy, there are a few people I know who work harder than my brother. We've all got really good work ethics in our family, but he is so loyal. He is very dedicated to his work. He's not afraid to pitch in and work and take overtime, whatever he's got to do. So
yeah, overtime. Especially now that it's not taxed, or at least for $25,000. But anyway, It won't work, really. I mean, it'll still work. It just won't make you rich. It'll just make you comfortable. If you save and just live within your means, you'll be all right. But if you don't have a larger income, then it's really hard to grow it as fast. Like, I'm able to save 40% sometimes just because I know I can live right here. I'm a kind of a bum at heart, so.
Yeah, Jeremy can live very, very inexpensively. He's totally fine with that. I'm probably not so much. I don't have crazy wild big taste, but I like to spend money. I really enjoy spending money. So,
but for you, somebody can have next to no income. They can have no income probably if they have the right relationships, and they can leverage themselves up to having a whole bunch of property that somebody else is paying for. So that's a great way to do it. It's a lot faster on the front side than the way that I do it.
Yeah, and that's one thing I'll say I admire. I admire about your style is it's just very slow and steady wins the race. The tortoise and the hare. You're just steady. I'm not. To me, that's I'm like a speed demon. I'm I gotta go faster. I gotta go, and that's probably not always a good thing. And so I admire people like you who are a little bit more controlled and not quite as not big wide swings. You're a little bit more like this emotionally. You and I have always been that way different that way. I'm real highly expressive and fly off the handle real easily, and Jeremy's just everybody just chill out. It's gonna be okay. Yeah, we could probably tell you some stories. That would be a whole other podcast. And I think, sort of a question, but do you think our personalities play into our wealth building styles?
Yeah, 100%.
It's just, and so this is why I wanted to have you on the show, because I wanted to explain to everybody. They hear from me a lot, and I tend to be this is the right way, and I kind of secretly believe that a little bit, but I also know that there's great value and a lot to be said for other ways, because one size doesn't fit all. It's different personalities, right?
Right.
So, yeah. So, I was going to ask, is there a middle ground? And I think there probably is, but I know that, like you said, you've toyed with debt a little bit, and I have one property paid off. So maybe we're both a little bit,
yeah.
It's not all bad one side,
Right.
What are your thoughts about that?
There's probably somebody who's got a good middle ground. Ryan probably has a good middle ground. Our cousin Ryan.
Yeah.
He has some money in stock. He's starting to build, rental properties. I think he has 2 or 3 now. So, he's probably a good middle ground. But not a middle ground I want to go to. But
yeah. Well, and this is where I'd say what pitfalls does a beginner have to worry about? Because I remember when Ryan was getting started. Shout out to Ryan, by the way. I know you listen, and so yeah, we love you. Love to have you on the podcast one day. So it's hard to get started, especially if you're a more of a risk averse personality and you are more of a cash person. To me, if I saved up that much cash and I had that much cash, I'd be more scared, I think, to buy a rental property than if I was putting down 5% or 10% or 20%, So maybe that's an insight into the way I think versus the way you think too. Because is that intimidating when you're putting down that much to buy a property?
Well, typically, I don't know if you've ever seen my properties.
Yeah.
It wasn't that much to put down. But
they're worth a lot more now, though.
Yeah, right. Yeah. They actually, I've come across some great deals. So the first property that I bought was a condo, one single condo in a fourplex. Somewhat turned out to be a nightmare, but I still own it, so it's still making money. and I bought that one for like $30,000, and it was rent. It was cash flowing like, you know, I don't know, 20% or 25%. Like if it rented for 4 years, it paid for itself. So, I mean, that one was an awesome one. And then I bought another little one that was, no. Then I bought the house that I lived in before my current house, and I bought that one at a police auction for like $70,000. Mm-hmm. And I moved into it and I lived in it, and it was awesome. I did a little work to it, but it didn't need much. And then when my house that I bought now, that I live in now, came up for sale, it was like my dream house. So I was like, all right, yeah, I'm buying that one. So that's how I got that rental. But it was only $70,000, not that much. And I had already lived in it, you know?
Yeah, Jeremy's got the best yard in Hammond, by the way. If you know where Peter Hammond's Oak is, it's right across the street. It's got like 5 gorgeous city park live oaks.
I love it.
And it's all uplit at night. Pass by. You're going to have plenty of stalkers now. Sorry. I hope that's okay.
So then I bought another one that was like a block from downtown for like $35,000. It had a hole in the roof. It was leaking into it. Like, it was terrible. So I bought it for $35,000. I let it sit there for a year. I knew eventually this house is going to make money, but it's a good deal. I'm going to just buy it and hold it. And then I made enough in my rental account to start fixing that one up. And it ended up costing me, I don't know, maybe $60,000. So I was all in probably about $100. And I mean, that one rents for like $1,400 a month, or $1,450 or something.
That's Hanson?
Yeah, that's Hanson.
Yeah, I was about to say. I know that one.
So, I mean, it's pretty good little deal, you know? I mean, they're probably worth $200 for Hanson maybe, and $250 for Easy Street. And I mean, I was into them, each one of those for probably $100 or under. Mm-hmm. And then I bought my condo. I bought the other one, the one that was above it started leaking into my unit, so I was about to have to put like $20,000 in to redo it, which is almost what I paid for it. So I was like, well, before I redo this one, let me buy the one above it if it's for sale. It was vacant for like 10 years. So I was like, if I can buy that one, then I'll just redo both of them. And so that's what I ended up doing. Mm-hmm. And so, I mean, really, and I bought that one for like $25,000, but I ended up having to put 20 into that one too. So thank God for cash accounts, some huge cash accounts, but also, you know, just doing it a little bit at a time. I mean, really, I don't necessarily, if looking back, there are times where I get tempted to sell everything and just put it into the stock market, because it makes my taxes a lot easier. It makes, you know, just less headaches of worrying about it. But I do actually enjoy that. So that plays a part of it. Like, I like having property. I like walking around the neighborhood and saying, oh, let me check on this house. Oh, I enjoy that. So it gives me an opportunity to play what we call Hammonopoly. TM, don't try to steal that from us. But yeah, I mean, it's fun. It's enjoyable to look and see a neighborhood grow and get better, and I like it.
Yeah, it is fun. Real estate, there's a special magic to it. I don't know. For some reason, I just think, I mean, even taking aside the leverage piece, which I think helps it grow a lot. I mean, you're getting cash flow, you're getting a tax write-off, you're getting property values increasing, especially in a town like Hammond. I know you're a big Hammond fan. I am too. Like, Hammond's been really good to our family. So
yes.
So if someone doesn't know which path to take, what would you say? Like, what advice would you give them?
If you don't know which path to take, just do anything you can. Like, whether it be save, whether it be take a loan out, whatever. Like, it doesn't matter, as long as you start somewhere. You have to start. And it's really hard, because you look around and you see people with $1 million 401ks or whatever, and you're like, I'll never get there. I'm not saving 20%, you know, that might be $100 a paycheck. That's $1,200 a year. That's not a lot. But that compounds and grows, and after 30 years, like that's, I think one thing is, a lot of people think, oh, your home is your biggest investment. Your home is your biggest investment. Well, it's really not that great of a deal if you don't look at like the only reason why it's such a good investment is because it's forced savings.
Yeah,
like
that's
people
so
are
true.
forced to pay down, and so they think, oh man, this is such a great investment. No, you were just forced to pay principal for 30 years, and so that's why it's a good investment, because it's forcing you to invest.
Yeah.
But again, I mean, you look at it, and this is just a total aside that doesn't have anything to do with anything, I guess. But a lot of people think, oh, well, I have this 3% note, so that's a great investment. I'm only paying 3%, right? Well, that 3% note, this is me getting on my soapbox. That 3% note over the course of 30 years, you're going to pay a lot more, and that's okay. I mean, it's still over the course of 30 years, 3%. So you would make better money arbitrage in that, and instead of paying that down, you would just use your whatever you would to pay that down to put in your investment account, and you make the difference. Yeah, that's a lot better way to go. However, if you don't live in that house for 30 years, then you didn't pay 3% interest, because your front end of your mortgage, you might be paying 95% interest. So if you're just planning on buying and selling these houses and re-upping that 30-year mortgage every 2 or 3 years, well then, yeah, you never get that 3% interest rate. You always paid a higher interest rate.
Yeah.
So then
you're dependent more on capital appreciation, like the appreciation of the asset, or the cash flow maybe too.
Right.
You know?
Right.
No, but that's really good, because I think you're making a strong point with the forced savings, because I think if people discipline themselves and just habitually or created good habits of saving and putting money away, just like it's in your mind, it's like a bill. You know, you have to make it a bill. Well, most people don't have that kind of discipline, that kind of habitualization, and they need to be enforced from the outside, like having a mortgage or like having 30 mortgages or whatever, like I have. I have lots of forced savings accounts. And so like that's actually how I think about it when I'm looking at, like, some days my cash flow isn't great, you know, and I'm like, gosh, like I got all this rental property, the cash flows. But then if I'm looking at my capital appreciation, my equity growth, all the things that are like the forced savings type of things, I'm like, okay, well, that's a snowball that's rolling. I can't feel it. You know, I can't live off the cash flow like you might think I could. But so in that way, it's similar to yours, because I'm not really counting on that. I'm looking at the long term, you know? Yeah. So, well, what's one other thing that you want our listeners to hear? I loved your advice, just start, because I think that's the hardest thing. I remember when we were talking to Ryan about this, the first one you do is the hardest one.
Yeah.
It's absolutely the hardest.
100%.
Yeah, I mean, isn't it so nerve-wracking when you go, whether it's cash or finance, you know?
Right. I mean, like, I can remember thinking, like, oh, man, what if, you know, I when I bought my first one, the first thing that happened was, like, a window broke, like, and I had to go out there and fix it and blah, 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 and it was such a pain. It was only $250, but it took me a day of going up there after work, fixing it, going home. Like, it's just a pain. And that seems like such a hassle. And now, when I had the $22,000 plumbing issue, like, that's like, you don't even think about that when you're first starting.
Yeah.
But like,
if you knew that would happen, you'd be like, never mind, I'm not even starting, you know?
But then when that came, I mean, it was very frustrating. And my fiance was like, I've never seen you like this. Are you okay? But I mean, yeah, so it was heartbreaking, but at the end of the day, it was an easy fix as far as money goes. Like, you just pay the money and it's done. And so, you know, I've had all these years of great income coming in. So, you know, this is just one of the times where you got to pay it out.
Like Dad says, Dad actually told me recently one time, like, and actually it's been a few years, but I love this response, because I was stressing about something, you know, and he was like, he's like, son, that's not a problem. That's an expense. There's a difference, you know? Yeah. And I thought that was really good advice. Like, you know, like the plumbing issue. It's stressful. It's like, you know, like, it's like, so.
That's 2 years of rent.
Right. Yeah, I know. But at the end of the day, if you can pay it, it's not a problem. It's an expense. Yeah. That's if you can pay it, I guess.
So, yeah, I mean, for me, I would say definitely start somewhere and then just live less than what you make. Like, if you can live less than what you make, you'll be all right. Like,
good advice. Live below your means.
Yeah. And be happy with that. Like, don't feel like, oh, I'm cheating myself out of it. Like, look around and say, man, this is pretty freaking great. Like, I live my life like I am on vacation. When I walk places, like I can walk to every place downtown and I feel like I'm walking around. Like, people are like, oh, you want to go here? You want to go? No, I really don't want to go anywhere. My life is my vacation. I mean, there are places I want to go. So, like, Hammond doesn't compete with Hawaii or the mountains skiing or, you know, the Bahamas, I'm sure. But, like, my life is enjoyable and I like it. Like, I love walking around and not having to worry about. The biggest worries in my life are come on Saturday and Sunday when LSU and the Saints play, and right now the Saints are they're a problem. But yeah, like that's the stresses in my life, and I like it like that.
Well, that's awesome. Well, thanks, Jeremy, for coming on the podcast today. I love it, and I really appreciate Jeremy making the time to come, and it's really been fun today to kind of explore our alternative like investing philosophies or whatever.
Yeah.
So whether or not you're team cash or team leverage, let us know. Put a comment in the show notes. Let us know, and whatever you do it with consistency and intention. So with that, any final words, Jay?
Yeah, I will say this too. Originally, and I wanted to address this, you had sent some questions, and one of the questions was which one is faster or which one is better or whatever it was.
Yeah.
And obviously, your way is faster. Better, it just depends. What's your definition of better? For everybody, it's different.
Great distinction.
Fast is better for some people. Easy is better for some people. Like peace of mind is better for some people.
Yeah.
So like better
predictability,
you have to define what better is for you. Like, and I know like Ramsey always says, what did he always say?
He says, stupid. That's what he says. That's what he says.
No, but he says something. I don't
know. I don't listen to him.
And I disagree with it. But it's something along those lines of like he always says we did a study into 10,000 millionaires, biggest study ever done, and what we found is this is the best way to get to $1 million, and that's not necessarily true. That might be the most common way to get to $1 million, which is what a study's going to show you. It's not going to show you the best way.
It doesn't have like a kind of subjective measures.
It's going to show you the most common way. Like the most common way to be healthy is do the X, Y, and Z. You have these athletes up here that are freaks of nature who are super healthy, and you have these people way down here who just have some random thing wrong with them and they can't get healthy. So like that doesn't mean that they're doing something wrong. It means that they're an outlier. That's not the most common way, but it still might work, you know?
Yeah.
So that's the important thing. I always, it hurts me when he says, this is the best way.
Yeah.
I'm like, no, it's just the most common way.
Yeah. Well, and that's an interesting distinction because I've thought that about Dave Ramsey can be kind of polarizing because he's very, very, he talks derogatorily about kind of like the other side.
Yeah.
And I don't appreciate that because I think he's wrong, you know?
Right.
But he's wrong in that because I don't like cast aspersions on you for the way you choose to build wealth. I tease you about it, we rag each other back and forth. But at the same time, I'm like, no, man, like that's like you just talked about. You described your life. You love it that way.
Yeah.
I love it this way.
Yeah.
Like that would be miserable for me. And this would be miserable for you. You'd be like, couldn't take it. You'd have a head of hair like this, right?
I don't know. Some of this might be genes.
Yeah, I know. We were born from the same parents. Though. Like, how did I get these genes? Anyway. But anyway, so yeah, that's a great distinction. And I think with Dave Ramsey, I've told people this before, he was bit pretty hard. He was heavily leveraged. Right. And he lost everything, and it was very painful for him. And he's coming from a place of not wanting anybody else to go through that, and I appreciate that. So.
Yeah, because most people don't have the discipline to just say, "Oh, I'm going to do this way," and if stuff starts falling apart, I'm going to work my butt off. Like you've had times where you had to work your butt off to dig yourself out of a hole because failure was not an option, and some people don't have that.
Yeah,
I mean. I bought that house from police auction as proof. the guy who lost it, it was probably a $150,000 house, and I bought it at police auction for $70,000. I was the only person there other than the mortgage company, and he just walked away, left his left clothes, dishes. I still use some of those. Thanks. Never mind people who come over to my house to eat. But yeah, like people don't have the grit to stand and like just deal with whatever comes their way. So yeah, for them, Dave Ramsey is probably the right way to go. But for other people, there are other ways to do it, you know?
And that goes into our personalities. Like some people can deal with that. Like, I mean, people are like, man, how do you, I remember Dad was like, man, how do you sleep at night? And I was like, I mean, fine.
Like this.
Yeah. Watch, I'll do it right now. So, well, awesome. Well, this has been a lot of fun, man.
Yeah.
Thanks for tuning in today to the Will Frederick Podcast, where we talk about real estate, wealth building, money, and life.